lawyers, guns and money. Send lawyers, guns and money.
Well, but welcome, if you're watching this, to Lawyers, Guns and Money. We are a legal web show brought to you by LawyerFair. For those of you in the room who don't know who LawyerFair or what LawyerFair does, we are a legal comparison service for businesses. We're dedicated to looking after or helping business owners find great lawyers at the fairest price. And one of those great lawyers, dare I say, is with us today, Jon Bloor. Welcome, Jon.
Yeah, thanks, Andrew. Thank you for having me on the show.
Well, it's great to have you, and thanks for giving your time. Jon is a partner in the corporate team at Pretty's. Pretty's are a firm based in Ipswich and Chelmsford. But I'm going to ask Jon maybe just to give you a little bit of background about the firm, Jon, and some of the work that you particularly do.
Yeah, with pleasure. So Pretty's, and this is slightly before my time, but Pretty's I think has been around since 1906. Originally based in Ipswich, but yeah, as you mentioned, we made the move about 5 years ago to expand to Chelmsford, which is been a very good base for us in Essex. The firm is about 100 people in total, and we pretty much are a sort of full service practice across the business aspect, and also with a big private client department as well. And my specialism, I mean, I've always specialised in transactional corporate work, so basically buying and selling businesses and companies. And I also get involved in some sort of general contract drafting, but tends to be more in specialist areas. So I've got quite a big practice of sort of national practice advising quite a few mobile app and web developers on sort of terms and conditions and licensing issues.
Jon, thank you for that. And there's two reasons why I'm delighted that Jon has joined us. One is that he is and is a very kind of active member of our panel, and we've had great feedback about the work that he's been doing for us. But also, I used to wear a different hat, as Jon will know. I was involved, or still am, vaguely involved in it, but I was certainly involved quite heavily in corporate deals. And Jon and I actually handled over a period of, I think it took 2 years, Jon, in the end, didn't it, to get that particular deal over the line.
Yes, felt like longer, I think, at times.
Possibly, yes. But Jon and I were involved in a quite a meaty deal that ended up with a great result for all parties, actually, in fairness. And it seemed, therefore, a natural platform to be discussing with Jon the topic of mergers and acquisitions, obviously from the legal perspective. And also, just to frame where we're going to go with this conversation, we're going to be talking really from the vendor's perspective, Jon, I think, aren't we? And there's clearly lots to talk about. It's a very detailed topic. But perhaps, like all good Hollywood blockbusters, we're going to leave open the opportunity of a sequel for buyers, for purchasers. And Jon, I'd like to start off with an area in M&A that I'm particularly passionate about, because it affected us, I think both of us, a lot at the tail end of deals, and that's the preparation. Because in a strange way, due diligence is always perceived as being the tail end, and a very important tail end to a deal. But actually, if you don't get the preparation right, the due diligence can be far more dangerous. And I suppose from the aspect, Jon, of you coming involved in the due diligence end of a deal, just talk us through where you think advisors should be brought in. That's a really important point as well, particularly from the legal perspective. And what are those early tick boxes that a business owner should be thinking about in terms of preparing with an eye to end of deal due diligence?
Yeah, well, taking the point first about advisors, I mean, it's a difficult question in some ways to answer. And I suppose, broadly speaking, we deal with two main sort of classes of clients. So there are some, I suppose, serial sellers, we call them, who are, high net worths and corporates who do a lot of these types of transactions. And with those kind of clients, to be honest, it's more, I think if you're doing your job well, it's more of an ongoing dialogue. And if the first time you get brought in is when heads of terms have been signed for a deal, then probably neither you or the clients are getting the biggest, the most value you could out of that relationship. But I think where it's much more difficult is for what you'd call the sort of one-off. It's typically a business owner who's sort of built up the business over many years and are now looking to do an exit, and it's pretty much a sort of once-in-a-lifetime thing. And quite often in that case, whilst the business may have lawyers, obviously they may well be looking, at instructing specialist advisors, so corporate finance advisors, and then specialist corporate lawyers to handle that transaction. And that is where it gets difficult, because clearly the clients don't, from a client's perspective, you don't want to instruct lawyers too early and have what you might perceive as sort of the clock ticking and bills running up when you don't really know whether a deal's going to happen. But then equally, we see quite often clients who try and sort of hold that process back to the last minute, and actually that's quite counterproductive, because you quite often find that actually ends up, well, maybe increasing the costs, possibly delaying the transaction, and in a worst case means that you get either a lower price than you might otherwise have got, or the transaction just doesn't happen. And it comes back to that point really that you made about due diligence, which is that when that due diligence process starts, you're going to have a buyer and their accountants and their lawyers just crawling all over your business, crawling all over the company. And if they pick up issues at that stage, then it may well be more difficult to resolve those issues than whereas you could possibly have just tidied them up yourself, resolved them if you brought the advisors in a bit earlier and started the process a bit further down the line. And you find that actually you're creating quite a big headache for yourself by doing that. But conversely, you don't want to bring in lawyers or any other advisors too early, especially if you don't define the scope of what they're doing and what you're going to pay them for defined bits of work. So it's very much a balancing act. And I think it's fair to say that the best due diligence processes and the smoothest transactions that we see, even that sort of 2 years is too short a time scale, because they're businesses that have been well run, well managed, not necessarily with a view to an exit, but there's been good governance and sort of record keeping and audit trails throughout. And the owners have then made life much easier for themselves when it comes to a formal process, because 90% of the groundwork for that has been done. And it's just finally, I think there is also, it's not just about the specific issues of, well, this contract isn't signed and the statutory books haven't been written up, because ultimately you can probably resolve that. But it also gives an impression of sort of confidence to a buyer as well. If they think everything's been well run and the overall impression they get is that everything's in sort of apple pie order, then you often find that affects their perception of the risk and how hard they will push on other sort of protections and security.
Well, John, as you know, I endorse pretty much everything you say there. And I think one of the key things that I would say is that the deal breakers, of which we may cover at the end of this chat, some typical deal breakers. But if you get that preparation right at the beginning, you narrow the opportunity of there being deal breakers at the end, and deal breakers can evolve in many ways, everything from price chipping to the whole deal collapsing. But the other quick point I wanted to pick up and just endorse there is that getting the right lawyers, or getting the right advisors in general, but getting the right lawyers at the beginning or within the process is really important. It may be that the lawyers that you have are good and experienced in many areas, but not every lawyer is experienced in M&A, and I think it's an absolutely critical point to make sure that the lawyer you retain for the sale of your business has experience, because I can tell from personal experience and having worked with John as well that the lawyers that know how it works get those deals done. And deals can be lost if they don't know exactly what the rules are and how to deal with the other side's lawyers. And frankly, the deal we had, John, was successful as much as because both sides' lawyers wanted the deal done, didn't they? They were open to discussion and negotiation and knew the rules.
Yeah, and I think that's an important point as well. And what we see is obviously we come up against quite a wide range of law firms on the other side of deals, and I think market practice has evolved actually quite quickly over the last few years, and it's often quite apparent if you're dealing with sort of lawyers who may have done some transactional work in the past but maybe haven't been too involved in it recently. It's actually quite easy to tell from their approach whether or not that's the case.
I don't want to go into too much technical detail here, John, and if anybody does want to follow up on this, then obviously John is at Pretty's and we'll be leaving his details at the end. Just one question that often came up in my previous work as a corporate deals broker was the issue of share sale, asset sale, and the confusion. I mean, if you've got just a minute or so just to clarify where it is appropriate and not appropriate perhaps to be doing one or the other.
Yeah, of course. So I suppose just to take a very short, quick sort of step back, you've obviously got those two structures, and the first one being where you hold the shares in the limited company and you just sell those shares to another party. And the key point about that really is that everything in that company, be it good or be it bad, so any sort of liabilities, assets, whatever else, stay with the company and the control of that company shifts to the new owner. Obviously, with an asset sale, the seller is actually that limited company itself, and it's selling, leases and contracts and assets and anything else it may have across to the buyer. So generally speaking, the times when you would say, from a seller's perspective, you face the issue obviously of being left with an asset sale with a company which holds cash, and which you then have to do something to wind up and extract that cash. So I think a key question from a seller's point of view is, well, get tax advice up front and find out how much that structure is going to cost you. And the reason you need to look at that is because buyers may well push for that because they perceive it as cleaner, because obviously they cherry pick the assets they want, they buy the good stuff and hope to leave the liabilities and the bad stuff behind. Whereas with the share sale, they obviously take all of it. And the other time there would tend to be a distinct driver is on sort of very small transactions. You tend to see sort of asset sale rather than share sale, partly because it's perceived as being a bit less complex and easier for the buyer to take all that stuff without having to go through a massive due diligence process, which they may not want to on a small transaction.
Yeah, excellent, John. Can I ask you just to, and this is a very difficult question to answer because every deal is distinctive and unique, but could you go through a typical timeline and process of how, for example, if a vendor comes to comes to a kind of verbal agreement with a buyer, how the process runs, the heads sale purchase agreement, and perhaps an average timeline of those two things?
Yeah, of course. I'll keep it concise because the process can, as we know, be fairly long-winded. But generally speaking, step one will be you shake hands on some kind of deal. The opinions on step two vary. So by that, I'm talking about signing up some kind of formal heads of terms that set out the key points. Lawyers vary a bit on this as to whether they think they're a good thing or a bad thing. Personally, I think heads done sensibly are worthwhile if they flush out the key points, make sure that everyone's sort of looking at things on the same wavelength, and just make sure there is a deal there to be done, and also just reduce a few arguments on points later on where they might get a bit clouded when you're looking at them in sort of 50-page contract. It's sometimes easier to talk about principles. And then once the heads of terms are signed, that would usually be the kick-off point for due diligence, and that is probably the biggest variable in the timescale, really. So we've seen recently anything from a couple of weeks start to finish, where you've got a buyer for whatever reason who isn't going to do very much due diligence, through to sort of several months of involved, not just the legal stuff, but the accountants doing financial due diligence and some commercial due diligence, insurance, all kinds of other stuff. So that is probably the area of the process where there can be the biggest sort of shift in timescale. And in parallel with that, and probably when it's gone a little bit down the road, you'd normally expect the key documents to be being put together, which is a share purchase agreement or asset purchase agreement. And whichever form it takes, it's going to be probably a fairly long, unpleasant to read contract. But basically what it says is what's being sold, what the price is, what the adjustments to the price are. So if you're going to assume a certain level of net assets or cash or something, there'll be an adjustment to make sure that that's correct. And any sort of deferred consideration, and then also a set of what are known as warranties, which is basically the sellers, the vendors saying, there is no litigation, there are no contracts other than what we've told you, etc., 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 and standing effectively behind those statements so that there'll be a claim potentially for breach of contract if they're not correct. And you then have a whole raft of other documents which won't go into in detail, but all the mechanics to make this stuff happen when you sign the papers, so transferring shares, changing directorships, changing bank accounts, all that kind of thing, will usually be, on a decent sized deal, there'll be a couple of hundred different bits of paper to sign up at completion. Timescale wise is, we would normally say to a client, if you've got heads of terms signed, there's nothing you're waiting for in terms of conditions, so no competition approvals or anything like that. We would normally say a sensible timescale is kind of, from probably 6 weeks to 2-3 months, depending on how much due diligence and how far advanced you are when you sign the heads. But we have done deals in kind of 48 hours from having signed heads, and as you mentioned, Andrew, we've done deals that take a couple of years, and deals which sort of get going grind to a halt, sort of then resurrected sometime later. So I'm always wary of timescales, and what I normally say to clients actually is, what do the parties want in terms of timing? Where are you up to and what needs to be done? And then to look at it on a more of a bespoke basis as to whether that's actually achievable in any given situation.
Well, thanks, John. I mean, there's a couple of points again I picked up on. The heads for me was always is always the vehicle to clarify exactly what both sides mean and understand. And it's about managing expectations, I always felt, with heads as much as anything else. And in due diligence, this goes back to the preparation point. The due diligence, the buyers, or ordinarily their advisors, will be getting under the bonnet of your business. And I always used to say that everything is still to play for at that stage. And again, if the preparation hasn't been done properly, if the heads aren't detailed enough for everybody to be completely clear on what the deal is, these things fragment very quickly. John, you'll know probably better than I the volume you've done. So again, it's all part of the process of making sure that you get the advisors in at the right time, you prepare properly, and you make things very clear within the heads as to what exactly has been agreed. So that's very useful. John, can I ask you, and this is kind of headline stuff, but maybe just to wrap up this phase of our conversation, obvious tripwires that you've seen that have caused problems for business owners from a legal perspective or even a wider perspective. Yeah. But are there kind of obvious ones that people should be thinking about from the very beginning?
Yes, there are, and I think most of them, in some shape or form, probably relate to the price that you're being paid. So, we were just talking about heads. So, one of the things you often see in a set of heads of terms is sort of assumptions about, so you might see that the price is on a debt-free, cash-free basis, or that there are certain assumptions around, net assets. And quite often, when you push the parties for details of exactly how that's meant to operate, you find that nobody's really applied their minds to it. So I think it's really important to get the terminology and the assumptions right. And I'm always actually in favour of sitting down rather than looking at sentences of text, but actually say, well, if net assets are X pounds, what are we expecting the price to be, and actually sort of sit down and make sure that both parties have the same result at the end of that calculation, because surprisingly often they don't. And I think from a seller's point of view, the other thing, and it's particularly relevant in the market we've seen over the last few years, where buyers are pushing to pay a lot of the consideration on a deferred basis, is looking at things like security for that. So if you've agreed a price of 2 million, but you're only getting half of that up front, what security do you have to make sure that the rest of it is going to be paid? And that also applies if you agree something like an earn-out, where you say, well, the balance of the price will be based on how well the business does in sort of 12 months after completion. Well, are the mechanisms in there to make sure that the business has to be run properly by the buyer, and that there isn't scope to manipulate that? And again, we touched briefly on warranties earlier, but I think it's also important as a seller to recognise that warranties or indemnities are really just another form of adjustment to the price. So if you don't negotiate those properly, make sure you've gone through a proper disclosure exercise to tell the buyer about everything they need to know, then you potentially find that you've gone through all those previous hurdles, got a price you're happy with, only to find that 6 months down the line you're being asked to write a cheque to settle a warranty claim, and basically you're being paid less than you're expecting for the business. And I think on due diligence, just to finally pick up on that, I mean, there are a lot of things that can come out of due diligence that cause a varying degree of problems. But just looking at those sort of deal breakers, we've had things like, they tend to be sort of fundamental assumptions or misassumptions. So we've had deals where the transaction is reliant on a property being used for a certain purpose, and you find that actually when you look into it, either under a lease or under planning law, it can't be. You look at things like really key commercial contracts, which when you look at them actually can't be transferred across to the buyer without the other party agreeing, and they're not going to agree. And it tends to be things like that which are really sort of fundamental to the business model of what's being sold. That tends to be the real sort of painful issues that just can't be resolved in a way which works for either party. So I think those are probably the headline points.
Well, that's great. And again, I'm going to re-emphasise this point, because I've seen so many deals fall down because the advisors are not experienced. An experienced advisor will see those things way down the track, as far as my experience is. Those issues that can cause deal breakers are much more obvious to people who've done a number of deals. So it's really important, if you are watching or listening to this, and it's probably only my mother and a couple of people in Western Australia who are ever going to watch this, but hopefully there's people here who are watching it, and it's really important to know that. So right from the beginning, whether it's your corporate finance advisor, your accountant, your lawyer, make sure that it's a team that really knows what they're talking about, because that vision that they have through experience is absolutely critical at all stages of the deal. John, I'm going to ask you one final question, and this actually relates to IT, which I know that both of us are quite keen on, how IT can be or is being or will be used in the future. What just on the M&A issue, how have you seen IT change the way that the M&A process works from a legal perspective? Have there been any innovations, or are there any innovations that are changing the way that you handle these deals?
Yeah, I mean, it's a very interesting question, actually, because what we've seen over the time that I've been in practice, so over the last sort of 12, 13 years, whatever it is, we've seen a push towards, when you talk about due diligence, to those due diligence documents being put in sort of online data rooms and, viewed through sort of web browsers rather than huge files of documents being sent around. And that's not really a new thing. But what we are seeing that is new, and this is actually led more by clients really than advisors, but it's clients balking at the cost of those solutions and actually pushing for what you might term sort of more consumer level type packages. So we've had quite a few transactions where the clients, or if we're on the other side, the buyers or the sellers, have come forward and said, actually, we're going to put all the due diligence documentation into Dropbox, and we're going to set up a sort of shared Dropbox. And it's not something that we would probably push or recommend necessarily as advisors because of the data protection and some security implications around it, but it's clear that that's what clients very much want. And again, on sort of document drafting, and this probably applies maybe more on towards some of the sort of web and app development companies I work for, but people saying, well, why can't we use things like sort of Google Docs so that we can actually work on documents collaboratively rather than using a model where you redraft it, you email it to me, and I amend it and email it back. And again, that's something which I think clients are pushing more and more for. And it's all very well, I think, as a lawyer to say, well, actually data protection and everything else, but it's probably foolish to ignore that trend, because whilst those solutions aren't probably ideal for what we're working with, it does show clearly what clients are looking for, and I think there is a degree of a gap in the market there for sort of cost-effective solutions which still properly address those data protection and security implications.
Well, John, that's a great response, and I don't know if you followed hashtag Reinvent Law last year, where if you are interested generally in how IT and how technology is going to transform the legal services environment, do hashtag Reinvent Law, because there's some very interesting conversations and dialogue going on there about changes ahead. So listen, John, thank you again. John is based in the Ipswich office of Pretty's. We will be leaving, I understand from those that know these things better than I, there's going to be a transcript available, John, of our conversation, in which will be more details about Pretty's and about John. So thank you so much for your time for joining us today. Hopefully we can maybe get you back from the buyer's perspective in a future webinar.
Yeah, so more than happy to come back and do part 2 at some stage.
Thanks, John. Thanks for your time. And thank you, everybody, for watching, listening. It's been Lawyers, Guns and Money, LawyerFair web show. Thank you very much indeed.
Send lawyers, guns and money. Send lawyers, guns and money.